All right. Welcome, everybody, and thank you for joining us for another fine addition to our Brick by Brick with Parvis Investments. Joining us today are the fine folks with the TASØ Hospitality Group, an exciting new addition to the Parvis platform for all of your investment needs. Just a quick reminder for yourselves, this content is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. Nothing in any of our presentations shall be construed as a recommendation or offered to sell or solicit any offer to buy any securities, just so everyone is aware. So my name is Michael Latrue. I'm glad to host once again on Brick by Brick. A little bit about Parvis. We are a technology-driven real estate investing platform with as an exempt market dealer. We bring institutional quality real estate investment opportunities to eligible and accredited investors, making the process as simple and seamless and as quick as possible for all investors involved. For more information, you're welcome to join us at parvisinvest.com. We deal mainly in the residential real estate space and branching off now into more exotic locales. So we're quite excited about that. So we look forward to answering any questions as well as presenting to you the TASØ opportunity that we have here with you today. So this is
All right. Well, thank you so much, Michael, for the introduction, for the space today to present to our viewers. We'll tell you a little bit about our portfolio, about us, what we're doing, the space that we've found, which we believe has a tremendous opportunity, both in terms of the type of hospitality which we're involved in, which is experience-based hospitality, and also the region. Central America is a region which is poised for significantly disproportionate gains over the next 15, 20 years in tourism. So we're at an intersection which we believe is extremely attractive, especially for those looking to gain exposure to the sector. Some investment highlights. We're currently in the middle of an equity raise, hence the presentation today. We are looking to raise an additional $4.7 million for our holding company called TASØ Holdings. That represents about an 18% ownership at $11 per share. The project, as it currently stands, is projected to return about a 23% IRR, representing a 5x equity multiple, and that would yield about a 10% annual dividend. We'll be using those funds for two main reasons. One is to expand our existing successful portfolio. So we've been operating for almost 11 years at this point, and we have really high performing assets where we need to add rooms because our occupancy is so high. So we're adding rooms at these already proven and successful high margin hotels, and then we're increasing our hotel count and expanding our principal brand, which is called Bambuda. Which is part of our overall strategy, this brand and the network effects that we'll touch on in a little bit. The funds that we're raising provide scalability. We're developing a really strong real estate-based capital structure, which will enable us to continue growing without raising additional equity. That's one of the most important considerations when we were thinking about structuring, is to have a really strong balance sheet, low leverage, which for hospitality, typically you see closer to 60, 70, will be below 50% with our strategy. And it'll allow us to grow organically at a pace that us as founders feel really comfortable with without having to draw on additional equity, maximizing dividends and returns for our investors. We have a really strong track record. As I mentioned, we've been operating for 11 years. We've, of course, traversed multiple market cycles from COVID-19 to protests every now and then in the region. We've really seen it all, and we're really experienced in navigating those successfully. We've always maintained a positive NOI margin, which in any market is laudable, and in this case, given the market cycles that we've seen, really reflects our operational skill and again, just experience. With the growth, the trajectory that we're planning on achieving, we're looking at a really strong exit potential at 16 hotels in about 8 years with 11 million in EBITDA. That opens the door to a lot of interesting exit opportunities, whether an acquisition by a larger brand, to private equity, going public. There's really quite a few options that will be available to us if we achieve this scale, which we're on track for. And in terms of alignment, us as owners, we started these hotels, really built them, with basically our bare hands in the early days, and feel a really strong emotional attachment to not only the product but the physical locations, and we retain 50% ownership in the company. So in terms of alignment, investors that are coming in now, same share class. There's only one share class. Dividends, when dividends are paid, they're paid to us equally as everyone else. So no one is more interested in the success of this portfolio. This is our baby, our collective baby, and we do everything we can. We really live and breathe this portfolio, and we'll do everything to make sure that it's successful long term.
Excellent. Almost like a joint venture.
Yeah, yeah, for sure.
Okay.
So I mentioned this a little bit. Central America, people are surprised to see just how well it's performing in the space relative to the rest of the world. It's growing tremendously. Part of that is it's this experience-based hospitality, which people are seeking, which Central America really lends itself towards. Strong cultures, really, incredible nature, the Caribbean beaches, the jungle, but also the proximity and the connectivity to North America. You've got the time zone friendliness with cities like New York, DC, direct flights from all major hubs through Copa. Panama is the hub of the Americas. That's what it's referred to because of its connectivity to the rest of Central and South America. The market that we're operating in, the boutique hotel market, is pretty informal. So there's weak competition just across the board. It presents a very interesting opportunity for a player like us that comes in with systems like revenue management, like sales and marketing, strong operations and administrative structure, to come in and really take over a large share of the market. Central America has really strong government and international support for tourism. Panama in particular, strong fiscal incentives. We don't pay income tax on our hotels because of the fiscal incentive in Panama. Things like that. There's a lot of investment in public infrastructure related to tourism, airports, new roads, high-speed internet. So there's a lot of movement in the space, and we're, again, just poised really to capitalize on that. And then the fact that these are dollarized economies, right? We charge our hotel rates in US dollars, but then the rates that we're paying to employees and in general for resources are comparatively lower relative to the United States and other markets where we're competing against. So, it's a blend of all these things to make Central America particularly attractive, and that is our area of focus. Our main brand is called Bambuda. We currently have 4, and we're focusing on the growth of this particular brand. You can think about it as the blend and intersection of boutique hotels with a really particular focus on social spaces and programming and experiences. So think guided hikes in groups, salsa classes, bonfires on the beach, cultural immersion. These things that you don't typically associate with just a hotel experience, and it's an intersection which really sits and stays with people, and you see that in the reviews and the loyalty that we're able to generate. These are design-forward hotels. The size of the hotel makes them intimate, so our guests typically form meaningful relationships to the extent that that's possible with our reception staff, with our bar staff, because they're seeing them every day. That's they connect on a personal level. So it's an intimate boutique hotel experience. We have F&B, so restaurants and bars at all of the locations. We have a really particular room mix. Room mix we refer to as the variety of room types that we offer. That is probably the most atypical thing about our hotel for those of you who have traveled and stayed in hotels before, which I'm sure is everyone listening to this. We have everything from a luxury dorm, which could start at $20, $30 a night. So that's where you're sharing a space with potentially 7 other people that you don't know, and you're in a pod, and you have your own lamp, your own electrical outlet, your own curtain. It's very cozy. It's very modern. You have a nice bathroom that you would see maybe like at a nice gym, an Equinox, or a spa. So it feels, kind of luxurious, but you are in a shared room. So you have that experience, and then you have something like a luxury suite, which you have what you would typically find at a higher end of 4 or 5 star boutique hotel, and all of this is within the same property, and that creates a really fascinating diversity of clientele that lends itself to experiences that you really can't find at other hotels. And that is something that you really have to stay at the property to see and understand. We encourage you, anyone on this call that's interested in learning more, to do that. We have a proprietary and modular tech stack, so the three of us were really tech forward. We are always looking for the best new tool, whether that's revenue management or project management or communication. We built it in a modular way to allow us to plug and play with the best that's out there. Of course, you're all aware, how rapidly technology is evolving right now. So many tools in the AI space and everything that's tangential to it. And existing sort of legacy larger brands, they're less agile because, of course, they have their systems built, over years and years, and it's very hard to shift. Because of where we are right now, we're able to pivot and really take advantage of the latest and the newest technologies. And we're constantly looking to do that. And I think that helps set us apart from some of the bigger players. And yeah.
Just before you go on, Seba, I'll just
Yeah.
jump in and add a little bit more on the brand. I saw your face, Michael, as we were describing the mix of rooms there, and it seems odd to a lot of people. But I think what's important to harp on here is that traditional hospitality segments clientele based on the price that they have to pay for a night to stay, right? When the reality is, what we see is there is a wide variety of people in all different price points that want the same experience, right? There's no reason to segment people in the hotel, in the common space. They all want to interact with other people. They all love travel. They want this more unique local cultural experience. But some people have a budget of $25 a night. Some have a budget of $300. They want something different from their rooms. So we're providing these different room experiences in the same hotel. The benefit to us comes in a couple of different ways. One is that because we have this segmentation within a given hotel, we're able to maintain much higher occupancy year round. We don't need to fill an entire hotel within a singular segment of the market. Because we're segmenting our hotel, we've got 5 to 10 rooms within each price point. So it's much easier for us to maintain our really high occupancies. In addition to that, people typically associate, people staying in dorm rooms as lower revenue, lower room rates. The reality is, when you start calculating on our dollar per square meter perspective, our dorm rooms are some of our best performing units, because in the same space that I have a standard room that I can charge $150 a night for, we're putting 8 people spending $25 a night, right? So we're getting $200 per room. Not only that, we have 8 people that are consuming in our bars and restaurants instead of 1 or 2, right? So all these things combined, right, is kind of why the business model works so well for us. And even though it's not what people are expecting, or it seems odd, you got to come to the hotels and experience for yourself and see how it all works together.
Yeah.
No, that's an excellent insight. That's actually pretty brilliant
Yeah.
to do it that way.
Absolutely, and we could go on. We could probably spend an hour just on this page because we feel it, we breathe it, and we see the dividends that it pays, and just how all of it compounds together to drive results. I'll just add 2 other things that as Alex is speaking, comes to mind, which we frequently discuss. One is the type of person that stays in this dorm also is an organic marketing machine. These are people that are jumping between different locations, and they're talking to each other, and they're going home, and they're talking to their friends about it. So actually, historically, we did very little marketing. Marketing is relatively new for us, and that's because we had such a powerful organic marketing machine in these dorm guests that go hopping and spend a month in the region, going from place to place, and we're just talking about their experience and how much fun they're having. So that's one part of it. And the second part of it is because of the different, what Alex is talking about, that we're really appealing to the same person, but with a different budget. What happens is that people will stay during different phases of their life cycle. So we'll get people that stay when they're first backpacking and they're 18, and they'll stay in that dorm. and then they'll say, wow, look at that room, look at that flagship room with that incredible view over the ocean, and whatever the amenities are, and they'll want to come back, right, when they meet the special someone, and they, on a trip or with friends, and they'll want to have the higher end version of the same experience. So we capture people in a larger life cycle, whereas other hotels are typically more constrained, right? It's a little bit of a narrower generational focus. So all these things compound. We think it's really cool. It works really well in terms of the bottom line, and yeah, we're pretty proud of it because we think we think we do it well.
Excellent. And yeah, I guess the future locations you're looking to build will sort of follow the same sort of formula,
Exactly.
or are you gonna
Yeah,
or
no,
okay.
that's exactly right. That's why we're focused on the Bambuda product, because that it really, it hones all of those things together in the best possible way, and it's much easier for us to replicate that formula, which we believe is a winning one. Yeah.
Excellent.
So, quick overview here of our current portfolio. You can see that there's 4 Bambudas currently, the top 4. And apart from the pretty pictures, and you can see these are all in wonderful locations, it's important to see that the portfolio is comprised of properties that individually perform really well. So it's not like we have a couple of standouts that are carrying the whole group. On an individual basis, these are all really really solid performers. And we, part of our strategy going forward, whether we're looking to sell, each of these is a perfectly sellable and high value asset. You can see that the lowest occupancy that we have here, Bambuda Castle at 75%, is still a very respectable one in the hospitality industry. Bambuda Santa Catalina here has a little asterisk. That one actually opened in July, so of course that 66% occupancy is not its stabilized one, and that's ramping up now closer to 75 as well. So some of our highlights here, I mentioned we've got the 4 Bambudas, 9 in total. We've got 1 in development, 220 keys, a bunch under construction as we're expanding our current key count at these properties. 73% occupancy in 2024. Just for comparison, Panama did 58% last year. Panama hospitality markets, sometimes when people have heard about it before, there's a lot of hotels, and historically they've not performed as well. So people are typically impressed to see how we do versus that. I think in Canada it's obviously a little bit higher, but still 73% is quite strong. Significant growth year over year. You can see 55% versus same period last year on NOI, our net operating income. That $130 average daily rate versus the 121 Panama average. That's including, and people are also surprised about that, even though we're selling some beds for $20, $30, how the effect that Alex is talking about, where you have 8 times 30 is 240. That's a much higher ADR than selling one room, plus the effects of the F&B consumption. 20% NOI margin in 2024. That's ramping up to about 30 as we bring new revenue online, and then that pretty impressive compound annual growth rate since inception of the portfolio of 24%. We're projecting to grow 23% at the IRR. So, essentially what we're showing is that we're expecting to grow at the same rate that we have historically. We're not showing some kind of a, hockey puck trajectory or significant change in the next few years. Really focus, here, of course, the majority of our income and revenue is coming from the hotel, about 55%, but we have a substantial amount of secondary income, secondary revenue from F&B, and then others, including, tours, rentals, what we typically lump into other operated income. But from the rooms, you can see here on the left, that's an example of one of our luxury dorms. We've got the flagship rooms, which are suites. And then we have one interesting room type, which another sort of point that sets us apart and helps to drive occupancy. It's a room that can be physically reconfigured in a variety of ways depending on the demand. So the picture that you're seeing there, you can see kind of on the corner 2 bunk beds, which can be sectioned off, and then you've got 2 twin beds. This room can be configured in 5 different ways. So it can be a standard, a double, a triple, a quadruple, or an individual, or a dorm, shared dorm. And that allows us to really get those margins. Sometimes in hospitality and hotels, you've got 2-3 days gaps that if you only have one room type and you've got friends or you've got a couple, it's really hard to fill those. with our size hotel, the hybrid room types allow us to really squeeze those margins. And that's why we're able to command such high occupancies in peak season.
And the way that works, I'll just add some is with, again, coming back to that topic of technology, right? We use a kind of top of the line modern property management software. And the way it works is it allows us to have all of those different configurations that Sebastian listed simultaneously on any given night, right? So that one physical room is being sold live 5 different ways. Once it's been purchased, those other options come offline. So when we say it can be reconfigured, we're talking from one night to the next, right? So depending on the demand, and we see fluctuations. Part of the year we have higher demand for the dorms, part of the year higher demand for private rooms. It changes week by week, and we are just constantly flexing based on what reservations are coming in.
Very nice. You guys put a lot of thought behind the whole business model for that. That's pretty awesome.
Yeah, yeah, it's a product of a lot of years of trial and error also, but we're just continuing here. We're driving these strong revenues, but it's important to see that operationally our margins are really strong. So these are again some industry comparisons. You can see that our both our rooms and F&B margin are very strong relative to the industry, and that translates, of course, to a higher EBITDA margin than the industry. And that's a result of a host of factors, but it really comes down to the fact that we are individual boutique hotels, but operating under a single administrative infrastructure that has shared accounting, human resources, sales, and marketing. So we're able to, in some cases, to share GMs, share general managers, people, an executive chef that's looking at procurement and constantly adjusting based on availability of resources. So it's really, you've got that that strength of a much larger entity being passed down to these individual hotels. So yeah, this is what's driving our bottom line results. Our customers are primarily from Western Europe and North America, representing about 75% of our total. These are customers that are typically spending longer than their regional counterparts in terms of the length of travel. They're coming for 2-3 weeks at a time, often hopping between locations. So in our case, a very common route is to arrive in Panama City, go to Boquete, which is in the mountains, then go to Bocas del Toro, and then continue to Costa Rica through a town called Puerto Viejo. We currently have locations in 3 of 4 of those that I just mentioned. We're now expanding into Casco. But so these people are, one, they're spending time at multiple locations, and 2, they're spending more per night in dollars and consumption than their regional counterparts. So also because of just the variety of cultures in Europe, different holiday seasons, different holidays in particular. So it's really flat. Like we get more Germans in February, more French in March, some months. The different airlines that come in help to balance each other out. So it's a very balanced customer profile in terms of the Western European and North Americans. And then anecdotally interesting that we got 58% female. We all know that women are more intelligent, and that's why they choose Bambuda.
Or why they go on vacation, because they take care of themselves better than male counterparts do.
Exactly.
So is the reason that most of the customers coming from Western Europe, is that just for a distance perspective? Is it closer for them than it is for people, say, from Canada to go to?
No, much closer. Much closer to Canada.
It's closer for Canadians and Americans, which represents opportunity, because we think Canada and the U.S. still comparatively larger population and have the opportunity to grow relative to Western Europeans. But yeah, Western Europeans just love to travel, and they really like the Caribbean.
They have a lot more vacation weeks than we do.
Exactly.
That as well.
Yeah, that
by
as well.
default.
Right.
Yeah, my family lives in France, so I mean, that's I mean, I'm first generation Canadian.
Okay.
So, but the rest of my family is all in France. Nice. So they'd like to travel a lot.
Right. And it's much easier for them to travel just in general.
So 5-6 weeks vacation a year, as soon as they start working. Yeah.
Okay. So great. Historical performance, you can see 2 things here. On the left is how our revenue has been growing steadily since 2015, really since 2014, with the exception, of course, of 2020, which was an anomalous year. We're projecting similar growth going forward. Again, this is not this is a continuation of a successful trend and not something new that we're pitching here. On the right, you have our NOI average, and you can see that we've always been above 20%, with the exception again of 2020, which in which we still stayed positive, which reflected our capacity to be agile and scale down when needed. But that 20% and above NOI is something that we've really been able to achieve through all of these market cycles, and I think reflects our capacity to continue doing so as we progress. You can see here our occupancy in that green line has stayed around that 75% and above, again, with the exceptions of 2020 and then the recovery. Going forward, if you look at our financial model, we're looking at that same occupancy, right? So we're not projecting a significant increase in really anything across our portfolio. These are conservative numbers that yield that 23% IRR that we've seen at the beginning. We believe there's the potential for upside as the market in general matures and as our brand becomes more well known. But we like to be conservative, and so we're just taking the same performance that we've had historically and projecting it forward. Little intros about us here. I think people can read these a little bit more or on their own. There's three of us. There's three of us obviously on this call. We have one other founder who's another Canadian who's not on the call. But we really operate as a team, as I alluded to in the beginning of the call. We are very passionate, not just about hospitality and our products, but about the brand and about growing this business. So we're very involved. We're very hands-on. We debate everything from where electrical outlets should be located to what new city we should be in, with the same fervor and with the same enthusiasm, and we remain committed to that, to continue driving the company forward as founders. Our growth plan, you can see here, we are currently concentrated in Panama. We're pretty much done with Panama. We only go into new markets where our guests are currently going to and currently demanding. We identify Costa Rica, Guatemala, and Colombia as markets that are mature enough for us to come in with our product and on day one command the same occupancies and ADRs as we do in Panama, and that's really the high level summary of our strategy, right? Just identifying where our customers are already going and getting into those markets. The 1 year, one property per year growth rate is a combination of the capital structure, which I mentioned at the beginning, only growing with additional debt and not needing to raise more equity, and two, our commitment really to the product and the quality. So not growing at a pace which would prevent us from ensuring that each product is faithful to the concept of the brand, and what we feel makes it truly special. So this growth plan that you're seeing, one per year through this region concentrated, we're not saying that this is the only places that we'll go. We think if things go really well, we'll look to other regions and we'll consider expanding beyond this, but we're laser focused on this strategy in the short term, and we believe it's well within reach. So that's our growth plan for now.
Excellent. And so with the new locations, is it acquisition of existing assets and then just sort of rolling into, basically repurposing them with your brand, or is it full new builds that you'll be?
We try to avoid new builds. New builds, of course, carry higher risk in terms of construction, in terms of timing, and putting cash to work. Historically, what we've done is acquired existing hotels or existing buildings and repurposed them, expanding them, renovating them. As long as they have the sort of the bones for the social spaces, for the room count, we're able to transition them very effectively to a higher yielding and better performing asset. So yes, that's what we'll continue doing. There's a ton in Central America of owner-operated properties that are underperforming revenue versus margin, right? Because they are typically operated by people who don't have much formal experience and formal know-how in hospitality. So you'll see, these really high revenues, but bloated administrative costs, poor revenue management, And so we're able to come in with our systems and, within 6 months of implementation and getting everyone on board, really improve the margins. So that's what we'll seek to continue doing.
Very nice.
Speaking of that, here's our two case studies. Two of our most recent acquisitions. Bambuda Bocastown was a owner-operated hotel. We saw the potential, the location for it to be our Bambuda location in town. We typically aim for about a 15% return on invested capital by year 3. In this case, we achieved a 19% return by year 2. So what we're projecting forward, coming back to our conservative sort of philosophy of projections, this has really been drilled into us as we've had to overcome the difficulties of getting bank financing in Panama, which we've done historically very successfully. We achieved that by projecting pretty conservatively. And we've applied that same philosophy going forward. So we aim that 15% ROIC. That's what we've modeled essentially going forward. But you can see in the last 2 projects, we've outperformed on that. And there's no reason to believe that we will not continue doing and outperforming these conservative projections. In the case of Boca's Paradise, very similarly, we were expecting a year 3, 15%, and by year 2, we were at 17.53%. Both of those projects are doing phenomenally and are poised to continue growing well beyond that 15%.
Very nice.
All right. Use of funds here. We have acquired new properties last year. This was a use of funds that actually came from when we first consolidated the company and started raising both bank financing and some mezzanine debt. So we're well into this use of funds. The 4.7 million that we're raising now helps us to complete the the last part of this, which is mainly portfolio expansions. But in general, we've acquired 2 new properties, including our first one in Costa Rica, the new Bambuda Santa Catalina on the Pacific side of Panama, which is the picture that you see at the top of this slide, and adding rooms to our existing properties. Quick operational and dividend snapshot here. Call attention to just the bottom line there, and you can see the dividend yield. That's at the $11 per share. So if you invest $100,000, whatever you invest on those $100,000, you would see that 4.5% return projected, of course, in 2026. Our first dividend will be in 2026. During 2025, we're still very much in growth phase, so we will not be distributing. Going forward from 2026, we climb pretty quickly to that 10% projected for 2029, and from then on, it steadily continues to grow as we continue to amortize our existing properties and revenues from increased average daily rates continue to increase. So the 2033 yield that you're seeing there, that's reflecting an exit at a 10% cap rate. That is similarly a pretty conservative exit estimate. The reality is there's precedent and examples of higher multiples for groups like ours with a strong brand, 11, 12, 13 x multiples. We chose a 10% cap rate because it's more aligned to standard real estate exits, which of course you all are pretty familiar with. So that's a placeholder there for the variety of exit potentials that we have.
Nicely done.
Here we can see the breakdown of our in-place revenue. So the blue represents all of the revenue that's coming from our existing properties, and the orange from new properties. So you can see that the majority of the portfolio is built on existing cash flows and cash flows from existing properties. So providing a really strong base going forward. The groundwork has already been laid. Here, where we're at, this initial state, we have that the equity base, and on top we've got a mix of financing. So we've got some bank debt, primarily with 2 large banks in Panama, Multibank and Banesco, and then we've got some mezzanine debt, some short-term bridge financing that we've used to advance on our CapEx construction. What we're doing now is we're issuing a bond in Panama, in the Latinx, which is a local marketplace for securities. And we're issuing a bond which will reduce do two things, right? Consolidates all of our debt, and it reduces our interest rate. And with that, we'll have about a 43% LTV, which is a very low leverage level for a hospitality real estate-based group. And we will maintain that below 50% LTV going forward. That's a key part of our strategy to really be insulated from market downturns and any similar eventualities, and will allow us to still continue to grow at that one hotel per year rate. Summary of the opportunity: $250,000 sample investment here represents about a 0.91% stake in the company. The projected hold is 8 years, again with that theoretical 10% cap exit, yielding about 10% average in terms of dividends per year, and $48 per share in total return when you take into account the proceeds from the exit, totaling about a 23% IRR and a 5 equity multiple. Investor access benefits we put in here on the right. We hope that the people that invest in our hotels are also passionate about hospitality and want to actually come out and check out our properties and see for themselves and really feel part of the part of the group and be ambassadors of it. And we think that these access and benefits will help to promote that. So really generous discounts on rooms and on bars and restaurants to get people excited and down, friends and family discounts, concierge services to make each visit special, curated property tours, meetings with us at the locations. We'll have an investor portal, thanks to Parvis, with really state of the art in terms of transparency and accessibility. Live performance dashboards, a little welcome kit for everyone, and then first access to our branded villa program, which will be launching in 2027, where we'll build some real estate units on our land. We've got some land to develop at our existing properties.
Oh, so people will be able to rent out villas, say if they're like a small group or...
Yep, villas if they're a small group, and also to buy, we'll be selling those units as well on the existing land.
Oh, nice, okay.
Yeah, none of that is modeled in, that's all upside. We don't include it because we're pretty conservative with it, but there's some interesting upside there as well. A little sensitivity analysis. We've got the base in the middle and then optimistic and pessimistic on either side. You can see what occupancy variances due to the average yields and IRR. So you can see really even in a pessimistic situation where we significantly underperform against our 10-year average occupancy, we're still seeing a 15% IRR, which of course is very respectable. And then on the optimistic side, if we continue seeing the trend of Central America growing, of this particular section of hospitality, the experience-focused hospitality growing, we can see IRRs in excess of 25% and higher than that depending on the exit. Breakdown of our holding structure. We've got the Bambuda branded hotels and then the independent boutique hotel collection. And all of those are structured under TASØ Holdings, which is a BVI incorporated entity. We did that for some tax benefits. So there's no dividend tax from the BVI. So it's a really tax efficient structure. It's one that is very modern in that sense. It's a lot of companies are gravitating away from Grand Cayman and more towards these BVI structures for that reason. And then we've got a management agreement with a sister company, TASØ Hospitality Management. That's governed by a management agreement. It's a relatively industry standard management agreement. And we included an interesting opportunity here for shareholders of the holding company to decide to acquire the management company if anytime between, I believe, beginning of 2026 and end of 2027. Is that what we decided on the window?
During 2027.
During 2027, exactly. Mm-hmm. During 2027, would have the minority shareholders would have the unilateral option to execute an absorption of that management company. Currently, it's basically operating as a break even centralized service provider to the hotels. Sustainability, we are, this is typically something that gets put towards the end, but we're actually very proud of this, and we feel that it's our responsibility, given the fragility of the ecosystems and the locations which we operate. It's environmental fragility, right? We have locations that are in areas with endemic species. There is a very specific poisonous dart frog on some of the islands. We're in locations where we have some species of sloths and monkeys that are endemic, that are really unique to the world. So we've got that on one end, and then we've got indigenous communities that are fully dependent on hospitality, and we've got, of course, the intersection of coral reef and the jungle. So we're in these really incredible natural spaces, and we feel responsibility to protect them. So we use things like biodegradable cleaning products. We are involved in early childhood education, in community cleanups, in really a broad range of social responsibility within our local markets. And then we also have strong corporate governance in place, currently in process of being certified as a B Corporation. Not everyone is super interested in that, but we're pretty passionate about it. So we'd like to definitely point that out. It's something that will continue to
But
grow.
definitely, I mean, people that travel to these areas typically they look for that too, right? I mean, they understand the fragility of the ecosystems out there.
Right. Yeah.
Having
And
been,
it's nice to know that you're going somewhere and not contributing to its deterioration, right? That you're
yeah,
staying at places that are,
absolutely.
yeah, exactly. We've surrounded ourselves with really strong, excuse me, surrounded ourselves with really strong advisors, legal teams. Arifa, international advisory firm, Morgan and Morgan, Fox Rothschild is our U.S. tax advisors, and of course we've got external auditors and audited financial statements going back about 5 years. So in general, just to show that it's not just us guys at the wheel. We like to surround ourselves with people who know more than us, and I think our corporate governance structure and our charter reflects that of a really mature company. Strong minority rights, drag along, tag along rights. Anyone who looks through that M&A will see that it's built on a really solid legal foundation. In terms of the common shares here, we've got that $4.7 million offering. The closing, we put a date of December 31st. We're looking to close before then. We're already taking in investments, and we expect them to be fully filled before that date of December 31st. But we're putting that as the final date. The use of proceeds, as we mentioned, will be for the expansion and repayment of some of that mezzanine debt, which we used for CapEx expansion. Got a minimum of $100,000 USD. For information rights, unaudited financials quarterly, so pretty standard there. I mentioned we'll have a portal where all of this will be super easy to access. And
Excellent.
on our dividend policy, two things here. One, to sort of as a reminder that us as owners of the holding company with the same share class, we get paid out of those dividends just like everyone else. So really strong alignment. And two, we've built into the charter a policy for the company to pay no less than 50% of its free cash flow to service, to pay for, after servicing debt, to distribute to equity. So it's a minimum of 50% only in the case that there is a shareholder who wishes to exit. We've got a share redemption policy, which allows shareholders to request an exit, and the company is required to use some of its free cash flow for that. In the absence of such a request, 100% of free cash flow is distributed as dividends.
Okay.
That's
And I guess a redemption, say if someone did have to make a redemption request, is it something that they request and then it's just done once a year, I take it, if we follow the policy that you have with the dividends?
We have a quarterly dividend policy, so as
Okay.
on the first quarterly distribution, that would be applied. And it's just, it's there's no order there. It's just whoever requests a redemption, everyone would be redeemed pro rata to that request, pending any whatever those requests are. Of course, that doesn't preclude anyone from selling to any other third party. That's just a built-in mechanism for the company to buy back shares from any shareholders who wish to exit. We expect that not to be the case, since it will be growing and providing attractive returns, but that is there.
Okay, excellent.
For the governance, we've got 7 board members, 2 independents, and standard, again, the minority protections, tag along, drag along, right of first refusal, approval rights over any changes in particular to minority shareholder rights, and that M&A term sheet is available for anyone who wants to look through that, as is the hotel management agreement. So it's 3% of gross revenue, 15% of net operating income. All of that is built into the financial model and yields that 23% IRR. We've also attached that. And then the internalization option, where the minority shareholders, as I mentioned, can trigger an acquisition. And that'll be fair market value determined by HVS or a similar independent third party at any time between January 2026 and December. So it is 2026 through 2027, Alex.
Okay.
Yeah.
Oh, that's right. Yeah. Mhm.
Yeah. Some risk factors here. I think these are just quickly go through them. Of course, we've got the market risks. We've seen things like COVID, which have a disproportionate impact on hospitality. Airline related things. Typically, we're quick to recover, but of course, that's always a consideration. Operational risks, as with always with hotels, financial risks. We're subject to interest rates on the bond issuance. There's a floor on those interest rates, but there's no ceiling. We've got the political and country risk. We're in Central America. It's not Canada. It's not the United States. But again, we've been here for 11 years, so we know how to navigate, and we feel very comfortable with how we're set up. And the conflict of interest risk that currently exists, as we founders participate in the management company as well as the holding company, and we're looking to resolve that through the internalization. And providing the investors the opportunity to, without our participation, decide to include that management company and create 100% alignment. So those are our risk factors. And I'm not going to go into the portfolio detail. We've put this as an annex, but anyone that's curious can peruse through these. A lot of pretty pictures and some details on each of the projects and some of the upcoming improvements. A lot of this information is also on our website. Encourage anyone to check that out. The best way to see this, if anyone's interested, is to book a flight down to Bocas del Toro and visit 5 of our properties in one go. You can see 5 of them in a day and a half. You can see all of our hotels probably in 3-4 days, and really get an idea for just how special these locations are and the vibe that they create. So would love to host anyone that's interested in coming, whether or not they decide to invest. We're always happy to share what we've created with everyone else.
Excellent. Well, that's impressive. I love what you guys built. I mean, it's there's lots there. Definitely lots to unpack with anyone that has any further questions. Always happy to myself answer them or get the group online for more of the nitty gritty, especially, I mean, I would assume in our case, lots of investors, when it comes to the tax aspect of it, to leverage how you guys have structured it to benefit from the tax advantages. But otherwise, yeah, no, it's a beautiful project. So just wanted to clarify. So in essence, investors are investing in an 18% tranche that you guys sort of segregated but participating in the entirety of the company itself of the.
That's correct.
Okay.
In TASØ Holdings,
That's awesome.
again, the same shareholder class as us as founders.
Okay.
Yep.
Oh, that's exciting. So then they're participating in the continued growth of
getting in at ground floor and at the beginning of what we think is going to be a really successful long-term enterprise. So somebody who's looking for that kind of exposure, we think it's a very attractive option.
Excellent. Well, thank you all for presenting and teaching us more about it. So for all of our guests that are joining us after this recording, well, thank you for joining us for another Brick by Brick. I was Michael Latrue with Parvis Investments. Always happy to share new opportunities with everybody and get some additional insights. So have yourselves a great day, and well, we'll go on vacation together.
Thanks so much, Michael.
Great.
Thank
All
you.
right. Thanks, guys.